Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, volatility and uncertainty continuing. So where can investors find opportunity? We'll discuss. Plus, how trade policy uncertainty is impacting the manufacturing sector. We'll dig into that. And Meta is wrapping up its week one of its antitrust trial. We're going to discuss key takeaways and the headwinds facing big tech. Half an hour into the start of U.S. trading, let's get a check on the markets here. Taking a look at the major averages, still moving to the upside, but not as significantly as they were just about a half hour ago. You got your S&P 500 up nearly 0.5%. Your tech-heavy NASDAQ slowing just a bit, but still up about 0.2%. The Dow being weighed down by those United Health earnings this morning. But let's flip it over to the bond market here. We're still seeing yields ticking up just a bit this morning. You've got your 10-year around 428, 429 at the moment. And you've got your 30-year yield up about 2 basis points as well. Finally, we're going to take a look over at Bitcoin, moving to the upside this morning, up about 0.7%. Well, today I want to bring in Stuart Kaiser. He's the head of U.S. equity trading strategy at Citi. He has over 20 years of experience in the industry, and he will join me as my guest host for the hour. Stuart, great to have you on today. I know that you've had a relatively easy past few weeks, so great time to have you come in and guest host with me. Talk to me about how you would categorize where we are at in this moment in markets. Can we believe any moment of reprieve and green that we might see on the screen?
Honestly, it doesn't seem like that. I think the message from the last call a week to 10 days has been the bad news is not fully priced. And I think that's at the stock level and it's at the market level as well, where you get headlines that, might have seemed relatively, run of the mill. Even Chair Powell yesterday gave you kind of a textbook answer. Tariffs are bad for growth. They push inflation higher. Yeah. And markets still sold off on that. So I think the message you're getting here is we're not out of the woods. Worst case things are not fully priced in. All that said, I do think the tariff delay and a little bit of flexibility on the electronic side does trim a little bit of your worst case tail risk off, but obviously is not to solve the problem at all.
Talk to me about that, because what was interesting to me about Powell was that this was his first time speaking since we had that 90-day negotiation news, and I didn't hear him sounding any more optimistic. If negotiations don't matter for Powell, should they matter for markets?
I think they definitely matter for markets. The Fed's been very clear. They're not going to incorporate anything into their forecast that isn't, fully implemented and happening now. They don't want to be dragged around by headlines or rumors or anything like that in either direction. Markets are obviously different. The markets are pricing a probability distribution on the outcome, and each headline can kind of, impact that. Our view is that the next 2 to 4 weeks extremely important. We need to see some good news on the tariff front, especially with our key kind of trade partners. If you get that, I think the market will say, okay, this is a playbook for how this can evolve over the next 3 months. If you don't get that, I think the market's going to have to really start to increase the recession odds on the view that these tariffs are going to be higher and longer implemented than they might have hoped.
And where do those scenarios potentially leave us? If we do get these negotiations, where do you see the S&P heading? If the negotiations don't pan out, how much more pain could there be?
Look, I think, we're in a very wide trading range here, call it 4,900 to 5,400. I think if you've got good news on the tariff side, you can get out above the upside of that range. It's hard to see us getting above where we were, let's say, on April 1st, which is kind of that 56 to 5,800 range. So yeah, I think you can get up to those levels if things go very well. On the downside, the support level is 4,900. And I think to get below that, you're going to have to see people start to increase the odds of recession, really cut the earnings and GDP forecast going forward. What the support level is below that, we're really not sure. You're going to have to explore that, but I'm sure the market will start targeting, 4,700, 4,500 on the S&P if we were to get to that level. And that's a big if, of course.
And we came into the year just with so much optimism. I was talking to so many investors the day after the election who were incredibly optimistic. They have since sent me a lot of worrisome text messages about how their portfolios are doing to start off the year. To what extent do you think that investors need to be hiding out in safe areas of the market while this starts to play out? And what does safety look like right now?
It's a good question. We do think you want to be quite cautious in terms of your equity allocation. I think the positive news we've seen to start April has been growth stocks have performed very well. They're up 10 out of 12 days. And that's going to be obviously a lot of tech is involved in that. But if we rewind to February, these were your most heavily held and highest valuation stocks. The valuation, I think, has come down enough over the last, call it 2 months, that people are again looking at the fundamental side of growth and saying this is maybe safety in the equity markets. If earnings estimates get revised lower, there's going to be a scarcity premium on the stocks that can provide that. And most of these large cap tech and growth stocks have a nice clean balance sheet. They pay dividends. They buy back stock. So I think what you've seen is the the painful derating in valuation has actually now opened up an opportunity to be in those large cap growth stocks as kind of a hiding place right now.
And one of the things I love talking to you about, Stuart, is what we're seeing in terms of retail investor activity, which you monitor so closely. How have you seen retail investors behaving specifically with regards to tech allocation?
Yeah, I think you kind of need to break retail into multiple parts these days. But the what we would call passive retail, which is kind of your buy and hold in your 401k community, they've definitely pulled back. I mean, there's been net outflows from ETF and mutual funds 4 out of the last 5 weeks. The retail trading community, if you look at something like levered ETFs, which retail traders like to use, the shares outstanding on those are basically at an all-time high. So I think what you've seen is a pullback in that more conservative buy and hold investor, but your retail sort of in and out folks, still seem to be involved. I do think our view would be that retail does tend to gravitate to large cap tech and growth stocks because, frankly, those are the largest weighting in the indices. And in your 401k, you're usually choosing between S&P 500 and NASDAQ 100 or something like that. So I do think the pullback from that community has added a little bit of weight on top of that kind of large cap growth cohort. But the folks that like to trade are still trading. So
this brings me to kind of a philosophical question I want to ask you about. A lot of the investors who I talked to in the retail space got started in 2020. They've enjoyed a lot of the AI euphoria over the past few years, and they're getting hit with a lot of reality now. To what extent can those more novice retail investors survive in this market without the institutional knowledge that hedge funds who move the market up $7 trillion in 10 minutes have?
Well, I tell you, some of the hedge fund community is complaining about what retail is doing to the market. So I think there's a little bit of a give and take there. Our view, look, the bottom line is there's a lot of ways to hedge. One of the biggest ways to hedge is just to own less. So I think if you're worried about the volatility in the market, you start with smaller positions and you kind of leg your way in as appropriate. So that's the easiest, most simple way to do it, I think, is just to be more conservative in the top type of stock you own and the amount of that stock that you do own.
All right, great advice, Stuart Kaiser. You're going to stick with us for the hour. Really appreciate your insights there. It's now time for some of today's trending tickers. We are watching Schwab, Ford, and Microsoft. First up here, Schwab reporting record first quarter revenue as market volatility boosts trading volume. Daily average trades jumping 24% in the first quarter, coming in above expectations. You can see the stock up about 2.5% right now. Next up, Ford preparing to raise prices as soon as next month unless President Trump follows through on potential tariff relief. This after the president floated the idea of pausing auto tariffs to give some companies more time to relocate production. The price increase will affect vehicles built in May, which will arrive in showrooms in late June or early July. Ford saying it won't change the price of vehicles in inventory right now. And finally, Microsoft getting a downgrade from KeyBank to sector weight from overweight. The analyst citing concerns about AI demand and monetization. Microsoft is scheduled to report earnings later this month. Shares down about 0.5% right now. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we're going to take a look at domestic and the global outlook for the impact of President Trump's tariffs. We'll be back with that next. The latest Philly Fed manufacturing index falling to a 2-year low in April, with prices paid rising to their highest level since July of 2022. Meantime, the National Association of Manufacturers' first quarter outlook survey found a majority of manufacturers said trade policy was the biggest challenge facing their business. For more, we got Jay Timmons, National Association of Manufacturers CEO, joining us in studio. Jay, can't think of a better person to talk to about how manufacturers are actually feeling about this tariff policy. What are you hearing?
Yeah, feeling is the right question because they're concerned. There's no question they're concerned. Look, the way that we grow manufacturing in the United States is to lower the cost of doing business. So think in terms of tax policy. We're still waiting for Congress to act on renewing the 2017 tax reforms, regulatory rebalancing, and to their credit, the administration is tackling that right now. We want to also see an expansion of domestic energy production. That should be coming as well. But the tariffs and the trade policy that's been announced, pulled back, announced again, that's causing a lot of uncertainty for manufacturers. And so they're kind of taking a pause and waiting to see what's coming next because we don't know.
We don't know, and that uncertainty is certainly playing on the market, but I'm curious, President Trump would say, I want to help you guys. I want to bring manufacturing back to the United States. What is the misconception?
Well, first of all, we appreciate that, and I don't think that there is any question that Donald Trump wants to grow manufacturing in the United States. That has been a mantra for him since he decided to run for political office. the key is, again, making sure that we have that certainty and that we have a reduction in the cost of doing business. So we're waiting to see what happens in the next 90 days. The president has said he's going to get these deals done. Manufacturers need to see progress on that. We were happy to see that today the Prime Minister of Italy is there talking about basically a zero for zero tariff regime, which means that we can participate in free trade with Europe if that is acceptable. We also want to make sure that as we're negotiating these agreements that we're pulling out some critical materials like critical minerals and chemicals and machines that are used on the shop floor. That's going to be really critical. And then hopefully there's going to be some focus on an incentive for manufacturers who are actually investing here, but still having to pay tariffs.
And Jay, I want to bring in Stuart Kaiser from Citi, who's also here with us. Stuart, you have a question?
Yeah, I mean, you mentioned certainty, but what if the certainty is very high tariffs? I mean, do you think there is still room for manufacturing sentiment to decline if we get certainty, but it is a pretty high number?
Well, it could, Stuart. I mean, I honestly don't know that. I would say that what I hear most from manufacturers, and I've talked to more manufacturers in the last couple of months than I think I have in the last few years, because they all want to know, okay, what's next, what's next, what's next? And I'm assuming that the president has a plan to move forward, and it seems to be contained within these 90 days. The certainty is going to be critical. But to your point, if the certainty is higher tariffs worldwide, then that is going to cause concern, not just for manufacturers, but certainly for consumers here in the United States. I think you've seen those indications, you even mentioned it on your in the last segment, that you're likely going to see inflation start to kick in again, and that's not good for anybody. So we're hoping that's not the case.
I mean, are there some manufacturers that are happy about these tariffs, that they do feel like it'll give them a little bit of an advantage globally, or is that just such a small minority?
I think that's a great question because, in the first Trump administration, tariff policy was really aimed at some bad policy decisions that were made by other countries. And you think China in particular. So think in terms of dumping or subsidization or the theft of intellectual property. The 301 tariffs were really, they were designed to get at those issues. You saw the 232 tariffs. And so you see some steel makers in the United States that appreciate those. Now, that has knock-on effects, obviously, for other parts of the economy. But yeah, there are some that like to see some level of tariff, but I don't necessarily think anybody wants to see a global tariff that really significantly increases costs, because that's bad for everybody.
And I'm curious if we can talk about the labor impact here for a moment, because there have been some mixed messages on that from the White House. Howard Lutnick saying that a lot of the labor might be automated if manufacturing is brought back to the States. And then we had Treasury Secretary Scott Bessent telling our network that the labor that it would bring back is not necessarily very high skilled, meaning it wouldn't be high paying. How would you describe the type of laborer that manufacturers are looking for right now?
I think I'm going to go somewhere in the middle of all that, because right now we have 500,000 open jobs in manufacturing, Madison, and manufacturing is the highest paid sector on average of any sector of the economy. So we want to fill those jobs with really high-skilled technical individuals who can do the work. And we hope to grow more jobs here, and they will be we will be in need of kind of those higher levels of skills, which pay more, and they're rewarding careers that last an entire lifetime.
Given the openings you just mentioned, how concerned are you about the immigration policy changes that haven't even taken effect yet?
Yeah, quite a bit, actually. Look, if you want to hire people in this country, you've got to have people to hire. And I don't think anybody wants to see, obviously, we don't want to see bad actors here. We want people who come here to come here legally, not illegally. So I think Congress needs to reinvent our immigration system so that we're focused on the economic priorities of this country. We have not done that for decades, and it's caused all of this chaos in the immigration system in both Republican and Democrat administrations. It's time to fix that. Congress has the power to do it, and they ought to take on that challenge because it's good for everybody and it's good for helping to fill. It's not the total solution. Helping to fill those jobs that are open all across the economy.
Jay Timmons, thank you so much for coming in. Really
Thank
appreciate
you.
it. Thank you. Well, the International Monetary Fund, the financial arm of the United Nations, issuing a warning about the ongoing global trade war. Here with more, Yahoo Finance's Jennifer Schomburger. Hey, Jennifer.
Good morning. The head of the IMF warning that President Donald Trump's tariffs will lead to markedly lower global growth, but isn't predicting a recession. At the same time, inflation is expected to rise. These comments coming in a speech here in Washington by IMF Managing Director Kristalina Georgieva ahead of the IMF's brand new World Economic Outlook due out next Tuesday, the first to include the impact of President Trump's tariffs. Now, Georgieva is warning that the longer uncertainty persists, the larger the cost, raising the risk of stress in financial markets. She warned that the depreciation of the dollar and the uptick in bond yields here in the U.S. should be taken as a warning shot, saying, quote, despite elevated uncertainty, the dollar depreciated and U.S. Treasury yield curves smiled. It's not the sort of smile one wants to see. Such movements should be taken as a warning. Everyone suffers if financial conditions worsen. She stressed tariffs, like all taxes, raise revenue at the expense of reducing and shifting activity. And evidence from past episodes suggests higher tariff rates are not paid by trading partners alone. Importers, she said, pay some part through lower profits, and consumers pay some part through higher prices. Next week, representatives from 191 countries will gather here in Washington for the IMF World Bank spring meetings, where much of the dialogue is expected to center around trade as the U.S. leads a new global reordering of trade. Georgieva calling on countries to lower their tariffs and non-tariff barriers. Back to you.
Jennifer, thank you so much as always. Appreciate it. President Trump saying on Truth Social this morning that trade negotiations with representatives from Japan and Mexico were, quote, productive. The White House set to meet with the Italian prime minister today as well. As the negotiations continue, how big of a global risk is presented by the trade war? Here to discuss, we've got Fabio Natalucci, Anderson Institute for Finance and Economics CEO. He was previously at the IMF, where he managed the Global Financial Stability Report, prior to that at the Fed and the Treasury. So you could call you the perfect voice to speak with about the risks of global trade issues. Fabio, thank you for making the time. If you were still working on this Global Financial Stability Report, how would you characterize the risks presented by the way that these tariffs have been rolled out by the administration?
Yeah, thank you. First of all, thanks for having me on the show. I'm actually glad I don't have to write that report now, because I think we'll be rewriting that report several times up to the last minute. I think the point to start from the beginning of the analysis would be that the shock is different this time. Compared to the financial crisis, COVID, the war in Ukraine, this is essentially a policy-driven shock that intend to rewrite the global order and financial order. And so it's a stagflationary shock for the US, so lower growth and higher inflation, and at the same time, a negative shock demand for the rest of the world. And what matters here is also, first of all, the size of the shock, right? This is a very, very large shock. Even with the 90-day pause, it's a very large shock. And then the question is, like, what do we know at this point? And when you consider hard data versus soft data, and how much faith you, in some sense, put on the soft data. There's a lot of survey out there that point to deterioration in sentiment, both consumer as well as businesses, whether this is the University of Michigan Conference Board. I think the crucial part is how to think about the uncertainty here. Uncertainty is like very big drag on both businesses. They can front run the business now, maybe run down inventories later, but they will be freezing investment and employment decision.
Yeah.
And then what about that's a risk of the supply chain disruption? There's some sign that this could be the next risk. And then consumer, we have tariffs essentially are a very significant tax increase to consumer. There's been a negative wealth effect from decline in equity prices. So it's very hard to model uncertainty. That's, I think, one lesson.
So Fabio,
I think what the Fed would be,
Fabio, sorry to interrupt you, but what changes this stagflationary shock to a recessionary one?
So I think it's going to be a point of how deep, if there is a slowdown, how significant that slowdown is. If it's a significant slowdown, there will be, in some sense, an offsetting of the upward pressure on prices, right? And this is what Europe is facing now, slower growth and inflation that is slowing. That allows central bank to cut interest rate. That's what we have seen the ECB has done today. The Fed, I think, is in a much more difficult spot. And Chair Powell yesterday was very clear that you can have two conflicting objectives. If inflation moves away from the target and if the unemployment goes up, then you need to use this balanced approach to measure how far are you from the objective, but makes their job much more difficult. And it's going to be a function of the size, I think, of the tariffs ultimately after the negotiation, as well as a function of the duration of these tariffs. How long they're going to stay high, how high they will be, will they come down on? And ultimately, I think it's going to be bringing certainty into the process. I think market participants can deal with certainty. If you know that the tariffs will be higher, you can rebuild supply chain, you can plan, you can invest. A big drag now is the uncertainty. You don't know what the end game is going to be here.
Right.
And that's what's a big drag.
So, Fabio, I want to bring in Stuart Kaiser with Citi. He's still with us. Stuart, you got a question?
Yeah, Fabio, my question for you would be on the central bank side of things. Would you expect this shock to force the banks to coordinate more? Or do you think, the different impacts in different regions might, get the central banks kind of moving in different directions? How would you think about that?
I think that the tendency would be the central bank to move in different direction, right? If you listen to Chair Powell yesterday and see what the ECB decision has been today, similar would be for other central bank. In some sense, they have a much easier job. If both economy and inflation slows, the response is the traditional response. You just ease monetary policy. The Fed, for the tension for the Fed is that you have these two conflicting objectives, and you're going to start see some of those tension, I think, on interest rates, right? You just see now the long end of the curve in the U.S. moving higher in the last few days, even though they have come down now. But you would expect rates in some of these other countries to actually go down. And then from rates, you go to the exchange rate. And that's, I think, what we're seeing that is very unusual in the behavior of the dollar. Usually when you have risk assets down, and rates move, particularly if rates move higher because it's an inflationary shock, you would expect the dollar to appreciate. Those were the expectation in the end of last fall. Or you see a very different behavior of the dollar, and that's what raises this concern, whether this is about fiscal concern, whether this is about foreigners trying to reprice dollar asset with a higher risk premium because of all the uncertainty here in the U.S.
All right, Fabio, we got to leave it there. Thank you so much for joining us. Appreciate it. Stuart, I do want to pick up on something Fabio was just speaking to with you, which is the kind of interconnected relationship of what we're seeing in the U.S. dollar and the bond market as well. How do you rate this idea that there is a loss to the United States' safe haven status in this moment?
I mean, it's a great question. You've seen gold move up quite a bit, and I think a little bit that's people saying I want to be short the dollar, but because of tariff uncertainty, I don't know what currency I want to be long against it. Yeah. So I'm just going to, kind of go the gold route. In the near term, though, there's really not a big enough and deep enough, government bond market anywhere else in the world for people to turn to. So it's a little bit hard to see a massive shift away just because there isn't a great alternative. But at least tactically, I think gold has been really a big beneficiary of it.
And nowhere else to go isn't always the best sign of confidence, right? So, but I guess it's hard to also bet against the U.S. long term is the takeaway for investors.
Yeah, and I mean, if you listen to Secretary Bessent, they don't feel like they're seeing a lot of foreign investors actually move away from treasuries. I know that's been, a popular narrative out there. And I think part of that is, if you sell, I don't know, 100 billion of U.S. treasuries, you have 100 billion you need to invest somewhere. Mm-hmm. And, where is that ultimately going to end up is the big question.
Yeah. All right, Stuart, thank you so much. You're going to stick with us for the next half hour here. We're going to have all your markets action ahead. So stick around. You're watching Catalysts.
There is a simple way investors can trade on the whipsaw moves we've seen from the SIBO Volatility Index. That is the VIX, just over the past few weeks. I'm Jared Blickery, host of Stocks in Translation, and let me show you just a very simple trading system I concocted based on the VIX surges. So just to recap, when the VIX goes up, that usually means there's some pressure on equities, and so sometimes if it spikes really high very quickly, that can be an actual buying signal. Now the trade-off is sometimes you get a little bit early into the trade. So the rule I was looking at is when the VIX surges over 45, you wait until it then closes under 30, and then you go long the S&P 500. Now we've seen this happen 11 times going back to the very beginning of the VIX in 1990, and Actually, we didn't have any signals until about 1997 because of the low volatility in the 90s. But here we see the results. 1 week out, we have median returns of negative 1.2%, with results only positive 45% of the time. So 1 week out, this is not a great strategy to be buying the S&P 500 off of these VIX spikes. But 1 month out, you get a median return of 1.6%, 73% positive. 1 quarter out, the returns improve, still keeping a 73% positive. That's 3 misses over the last 11 times. And then at 6 months, we get really nice returns, 13.6%, along with that same percent positive. Now, if you hold all the way out to 1 year, you get about 90% positive and returns approaching about 20%. And that just illustrates that it's better to be a buy and hold investor and kind of wait and maybe dip in the waters when we see some of these pullbacks, not expecting these moves to really generate any immediate profits. Now, B of A just released a similar analysis where they looked at the same data set going back, and they found the same 11 instances when the VIX spiked above 45, but they bought on that. They didn't wait for it to close under 30, and the near-term results weren't that great. But if you go out 6 months, they found in 10 of 11 instances that it was actually a great trade, and it worked out 10 of those 11 times going out 6 months. So again, buy and hold seems to be a better strategy than trying to fade or enact these moves based on these VIX spikes initially. I have another way of looking at the data here. This is a chart that only goes back to about 2008, not all the way back to 1990, but it shows you some of these signals here. And for instance, in 2009, we had a signal that was kind of late. We had this long period of elevated volatility during the global financial crisis. Took a long time for volatility to come back down below 30, but when it finally did, that was a great signal to get long. In 2011, it looks like that was a little bit early as well. 2016, pretty good signal there. 2018, that was Volmageddon, great. And then we had the pandemic. That was a pretty good signal. And finally, we just had one in 2023, and that was a little bit of a signal. That also produced profits going out, excuse me, that was 2024, produced profits going out at least 6 months. We haven't even hit the year mark. So we have not had recently a VIX close under 30, so we do not have that signal just yet. But again, over history, things tend to work out 6 months to a year down the line. I'm Jared Blickery, by the way, and make sure you tune in to Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
All right, Jared, great overview as always. Thanks so much. Let's take a look at the major averages right now because we're still seeing movement here to the downside. Actually, markets flipping to the downside. You had your S&P and your tech-heavy NASDAQ in the green when the market first opened, but now you're seeing a little bit more selling here. Your S&P off just about 0.1%. Your tech-heavy NASDAQ off about 0.5%. Seeing a lot of the big tech names driving some of the declines here. Alphabet down over 2% at the moment. NVIDIA down over 2.5%. Some of that tech selling continuing this morning. We're finally going to take a look over at Bitcoin here as well. Taking a look actually at your treasury yields. You've still got yields moving to the upside here. Your 10-year keenly at 4.3%. And now we will take a look at Bitcoin down about 0.5% at the moment. Well, the theme so far this earnings season has been uncertainty as companies brace for the impact of tariffs on their businesses and the global economy. 2 S&P 500 companies have pulled guidance so far, finding it too difficult to forecast future earnings in this environment. That's according to FactSet data. Meantime, investors dealing with a highly volatile market fueled by this rapidly changing trade policy. So as earnings kick into high gear here, we want to know what options traders are pricing in for the coming weeks. And for that, we've got a great voice, Amy Wu Silverman, an equity derivatives strategist over at RBC Capital Markets. Amy, great to speak with you here. We haven't seen a ton of earnings volatility so far. To what extent are you anticipating that changing?
Yeah, look, we're relatively early into earnings season, and typically, especially with the financials kicking off, they've been okay. But as we get deeper into earnings season, when the bulk of Mag 7 reports, for instance, when we get to week 6, when the retailers report, I think there's a potential for more fireworks. Just coming into this earnings season, when you look at what the options market was suggesting that one-day earnings move was, it was relatively high compared to other quarters. Probably last time we saw the levels this high was actually during COVID. So, that kind of speaks to the uncertainty that is being baked into the derivatives market right now.
And talk to me about what is going to sort of drive the volatility moving forward this earnings cycle. Will it be company results or will it be news coming from the White House?
The news from the White House will definitely influence the company results to some degree, in particular to the forward guidance. And, I had a client say to me, look, right now, I'm not really invested in companies. I'm invested in management teams. I thought that just was an interesting way to differentiate kind of how people are parsing that uncertainty. I thought it was so interesting yesterday when United Airlines kind of gave this binary, scenario-based guidance. And, I think that's kind of what companies have to think about in this environment we're in right now, where there are just these kind of almost option-like outcomes depending on what is going to come out of the White House.
And Amy, we've got Stuart Kaiser of Citi in studio as our guest host today. He's got a question for you, Stuart.
Hey, Amy, how are you? I guess one question I have, thinking about White House impact, what's been interesting this time is it almost seemed like equity volatility moved like before credit volatility. And historically speaking, equities tend to take their signals from other asset classes. Like, how are you seeing that relative pricing right now between different asset classes?
Yeah, it's such a great question. So interesting to me when I kind of think back, Stuart, to the price action like right post Liberation Day, because we kind of got this one day where I think investors said to me, the equity market's reacted, but equity vol hasn't reacted. That lasted like 24 hours. And then we got the equity vol move, the kind of credit move after that, and then the rates move after that. And to some degree, I think it comes down to you think about the fundamental investors who had to think about baking in tariffs, right, into their margins, into, what the companies are going to do going forward, looking at the inventory builds. And I do think this time around, kind of equity and equity vol at least got it more right earlier versus the other markets where there was a bigger degree of catch up. And I think as we get into earnings season, that kind of idiosyncratic risk is even going to get more shaken into the models about exactly what will happen if the tariffs become real.
And I mean, at these level of implied moves, do you think there's enough risk priced in? I mean, some of these stocks that are announcing stuff you might have expected are still moving a lot. Like, how do you think about that? Is there enough risk priced in ahead of earnings season?
Yeah, look, I think it is really dependent on the company. And it's interesting because you have some companies like Walmart, for instance, which essentially, have said, I think we'll be okay. And then you've had other companies where essentially they've just pulled their guidance altogether. And that kind of goes back to the comment that one of our clients made, which was simply just, I'm investing in management teams. In the same way that you think about kind of what is going on in Washington right now and how much hinges on the decisions of one man, I think it really comes down to what hinges on the decisions of certain management teams, how they go through this environment. And I think this kind of secondary issue that's happening is there is a little bit of gamesmanship, right? So, I would say investors have told me there's some companies who are just going to kind of take everything down because they can get away with it right now, right? And, and people kind of have to think about that when they're also investing in those companies during earnings season.
So where does that leave investors who might be looking to trade on these results? And I'm specifically wondering, as we head towards NVIDIA, what would you say is maybe the go-to options trade or something for investors who are looking to trade options ahead of NVIDIA results that they should be looking at?
Yeah, for a lot of these companies where going into the year, people were heavily positioned, it obviously to some degree comes down to what your positioning was in the name. I'd say one risk that I don't hear many folks talking about right now, but I think it's really interesting, is just this idea that, the right tail is as much of a risk as the left tail. If you kind of just rewind back to March of 2020, I'd say, despite the fact that 2016 was kind of the beginning of the first trade war era, most people feel like this feels more like March 2020, but your biggest risk in that time period was actually this rip to the right tail. And I would say that's something to consider in names like NVIDIA, where you've seen, that call skew inversion, that huge bid to the right tail when things kind of go more right than is anticipated.
All right, Amy, great overview. Thank you so much for joining us. Really appreciate it. Coming up here, Meta's landmark antitrust trial is underway. We're going to speak with a guest about how the case could reshape the U.S. economy for decades to come. Stick around for that next on Catalysts. The first week of Meta's landmark antitrust trial underway. CEO Mark Zuckerberg claiming the company has no monopoly, as the FTC argues the tech giant illegally maintained a monopoly in the social media market by acquiring Instagram and WhatsApp. Joining us now, Slade Bond, Cuneo, Gilbert, and Ludica, Public Policy and Legislative Affairs Practice Chair. Thank you so much for being here with us, Slade. Talk to me about what you anticipate coming out of this trial is obviously expected to last about 2 months here, but what are you thinking this is going to look like 2 months from today?
Well, thank you, first of all, for having me, Madison. This is a blockbuster trial that is decades in the making, years of investigation and work in the making. And the FTC is alleging, as you said, that not only is Meta a monopoly, it has been for more than a decade, but they maintained that monopoly through a series of anti-competitive acquisitions of Instagram, WhatsApp, and other companies. And we are really in a pivotal moment. This is a make or break case for antitrust for not just this market, but for the U.S. economy at large. It's a big case that's years in the making, and it's going to mean a lot, not just to the companies that are competing with Meta, but small startups, builders that really want to compete on the merits, that just want an opportunity to compete.
And talk to me about some of the data that you have crunched the numbers on that indicates just how much this could cost Meta moving forward, because that's obviously of high interest to investors who want to know what the financial stakes are here.
Well, that's what's so interesting, Madison. What we found in trial this week is that Mark Zuckerberg actually emailed his team about this question a few years ago, back when antitrust scrutiny was first taking off. And he had this thought experiment about maybe it would actually be healthy for the company if they're not enmeshed in all of these investigations, if they're not constantly defending their conduct going back to 2012, and instead are actually focusing on innovation. And he thought that could be quite good for the company. And we've seen this in other markets as well, where you have immense antitrust scrutiny, immense litigation, and companies are actually stronger on the other side of this. Brad Smith, the president of Microsoft, has made this point a number of times, that Microsoft going through the challenges of a monopolization trial actually made it stronger as a company. And you look at the market caps of these companies, and it is prima facie evidence that they are succeeding and thriving, notwithstanding going by the rules of the road for competition. So I think investors should not be scared off by antitrust litigation. I think the opposite is true, that to the extent that Meta is focusing on building the next great product and not just copying its competitive threats, not just gobbling up competitors, you're really going to see innovation take off. And again, don't take it from me. This is something that Mark Zuckerberg was saying to his team several years ago.
And Slade, we've got Stuart Kaiser with Citi here in studio with us. Stuart, do you have a question?
I guess, if they were to rule against Meta, is the outcome a breakup? Is it a spinoff? Is it fines? Like how should investors think about what that next phase would look like if it were to go in that direction?
Well, there's several things that have to happen in this case before we get there first. And the big thing happening in the litigation this week is really around something called market definition, which is incredibly wonky, but very important in antitrust litigation. And essentially, what the FTC is alleging is that Meta is competing in a market for personal social networking services, which is admittedly very technical. And Meta, on the other end, is saying they compete with Apple's iMessage, with YouTube, with TikTok, and basically any company that has similar functionality to Facebook or Instagram in this case. And that's simply not true. That's not something that has shown up in Meta's documents. It's not how it views its market. It's not how Mark Zuckerberg has talked to his other executives about how he views the market, but it's what they're saying now. So Judge Boasberg, who's the presiding judge in the case, has to be convinced that Meta has monopoly power in this relevant market and it abused that monopoly power, and that there are no pro-competitive justifications, reasons why consumers were better off, notwithstanding Meta's monopolization. But once we get there, and it's going to take a long time, as Madison said, once we get there, I think divestiture is on the table. This is a case of monopolization by acquisition. The judge has already said in the case that is one of the most prime examples of anti-competitive effects. You can't find better examples. And I think divestiture is on the table. Now, whether it's Instagram or WhatsApp, I think that remains to be seen. I think there's a stronger case so far based on what Judge Boasberg has said, that Instagram is primed for being broken off from Meta's family of apps. But the bottom line is that the court has to be convinced that that's going to be pro-innovation, pro-consumer, pro-competition. And I think it will. I think that we've seen during the period of Meta's monopolization that the newsfeed has really become what I like to call pink slime.
Yep.
There's a lot of content that people don't want to see. A thing we learned earlier in the case is that the most common complaint among Meta users is that they just don't see their friends' content anymore. This is like 3 out of 4 complaints. And that they're seeing more ads than they would in a competitive market. And that's something that Mark has apparently called an ad tax. Like they recognize that they have the ability to turn the lever left or right on how many ads you see, what kind of content you see. in the interest of harvesting and monetizing your attention. So going back to your question on like how likely a breakup might be, I think this is an incredibly legally strong case for it. I think the case law is incredibly supportive, and there is a high evidentiary bar to get there, and it's going to take some time, but I think it's totally on the table.
Slade, we got to leave it there. Thank you so much for joining us.
Thank you so much for having me.
Coming up here, stocks turning negative for the third straight day in a row. How one financial advisor is telling clients to approach the uncertainty. That's next on Catalysts. Stocks turning negative today as investors process the latest comments from Federal Reserve Chair Jay Powell amid tariff uncertainty. In an environment where investors are concerned about possible inflation or even a potential recession, is now the time to change your investment strategy, or should you stay the course? For this, I want to bring in Lee Baker, Claris Financial Advisors founder, for this week's FA Corner, brought to you by Capital Group. Thank you so much for being here this morning, Lee. So I get it. We keep hearing about people nearing retirement. They're changing up their strategies here. But what about those folks who do have a longer term investment horizon? Are you hearing about them selling out of their stock allocations at all right now, or are those more long-term investors staying the course?
Not a lot. Yeah, I'm not hearing a lot of the people that have a while to go before they need those funds selling out. We've gotten a few of those phone calls, but that's been balanced against some of those phone calls that came in and said, hey, listen, is this perhaps like back in 2020 with COVID? And do you see any opportunities so far like you saw in COVID back in 2020? Now, the answer to that question is no. I'm not comfortable with any opportunities yet that jump out at me and say, yeah, listen, let's grab a bucket of whatever stock. But there's balance there between people that are saying, hey, now is this a good time to buy? But just a handful of people saying, listen, let's reallocate because this is making me too nervous.
So then where is that opportunity for those investors who are maybe looking to deploy capital in this moment? Are you thinking that there's opportunity still in the United States, or should they be looking more global?
I'm thinking looking more global, and I've been thinking that for a while, which has only been accelerated by everything that we've seen in the last few weeks. The international markets trailed the U.S. as we were coming out of COVID, and when we look at overall valuations, the relative value here in the United States versus a number of areas abroad, the international market looks much more appealing to me over the long term.
And I want to bring in Stuart Kaiser with Citi. Stuart, do you have a question?
Hey, wait, if you're one of these folks that actually got a tax refund, this month, and you want to keep your money in the U.S., I mean, are you telling folks to put that in bonds or maybe buy a really safe stock? Like, how are you recommending new money get allocated at this point?
Yeah, with some of the new money, we're looking at a couple of things. So you mentioned bonds. Because of the potential impact and, in my opinion, the likelihood of an increase in inflation, we've been looking at TIPS and shifting the fixed income allocation, a lot of our client portfolios, towards TIPS ETFs. So that's one area that we think, in the grand scheme of things, is relatively safe. The other thing that we've been making more allocations to are a variety of what are called buffered ETFs, where we're having the conversation with some clients and saying, listen, I don't believe in getting in and out of the market. There is no market timing Hall of Fame. Nobody gets it right, including myself. But if you're willing to give up some of the upside, if the market turns around from where we are now, in order to have that floor and cut off any potential losses over the next 6 to maybe 12 months, that's an opportunity as well where we're looking to deploy some capital.
And how would gold fit into that math for you?
So gold is one of those things that we think, hey, listen, gold and other natural resources, so don't want to forget about copper, silver, and all the rest. Gold absolutely fits in there. Now, gold gets all of the attention. In my opinion, it's a part of the fear trade. People for eons have considered it a store of value, and we've continued to see some run up in gold. The thing that you have to remember with gold, particularly if we're looking at it from a physical standpoint, is, hey, listen, you can run into your local Costco and get a nice ingot, and that's fun. But what are you going to do when it's time to sell it and you need to deploy that capital? You need to spend those dollars. So perhaps consider a gold ETF in small measure. It's not something that I suggest making a wholesale shift into.
All right, Lee, we got to leave it there. Thank you so much for joining us. Appreciate it. Stuart, I want to go to you here as we wrap up the show. We got just about a minute left. You're seeing selling continuing this morning. We had a couple of minutes of green shoots on the screen. Where are you anticipating the day heading from here? How much more pain could investors see?
Well, I think the question is, for equities, you're actually going into a weekend.
Mm-hmm.
Do you want to carry equity risk into the weekend, or do you want to be more conservative into the weekend? I think, lesson learned this year is you probably want to be a little bit conservative going into the weekend. So it wouldn't surprise me if we saw a little weakness into the afternoon. But obviously, it's, we could get a headline in 2 minutes that would 100% change that view. And unfortunately, that's just the world we're living in these days.
That certainly is. Keep those notifications on, everyone. Stuart, thank you so much for joining us as our guest host for the hour. Really appreciate it. Coming up here on Yahoo Finance, we've got Wealth, dedicated to all of your personal finance needs. Our very own Brad Smith, he's going to have you for the next hour, so keep it here for more.